Hey everyone, welcome back to Corporate Decoder, the place where we untangle the complex financial statements of the world's biggest companies. And today we're diving into global industrial companies' latest 10. Get ready because we're going to uncover what their numbers really mean for their future. And hey, if you like breaking down these reports, make sure you subscribe and join our Discord community, linked in the description below, for even more exclusive content. Alright, let's get straight into it. Global Industrial Company, or GIC, as you'll see on the stock exchange, is giving us a look under the hood for the year ending the 31st of December, 2025. This is their annual report, the big one, so it should tell us a lot about where they stand. First up, let's talk about sales. The company reported consolidating sales went up 4.8%, hitting about $1.38 billion. That is a nice jump from the year before. They also saw their average daily sales climb by 3.2%. This tells us they are selling more each day, which is generally a good sign. Now, what about their profit margins? Their gross margin, which is the money they make after directly paying for the products they sell, improved to 35.5%. This is a solid increase from 34.3% last year. For investors, this is a great sign. It means they're either selling at better prices, managing their cost of goods better, or a bit of both. It is basically showing they're getting more bang for their buck on what they sell. Moving down the income statement, their operating income from ongoing businesses jumped by a healthy 21.2%, reaching $97.6 million. This is money earned from their main business operations before accounting for things like interest and taxes. A jump like this often means the company is managing its overall expenses well while sales are growing. And for the shareholders, the bottom line looks pretty good. Net income per diluted share from their continuing operations increased 17.8% to $1.85. This is the profit allocated to each share of stock after all expenses and taxes. It basically shows the company is becoming more profitable on a per share basis. However, not all numbers are perfect. They're selling general and administrative costs, or SG&A went up as a percentage of sales by about 0.3%. This means their overhead costs crept up slightly relative to their sales. They specifically mentioned salary and related costs going up, including variable compensation and stock-based compensation expense. While not a massive jump, it is something to keep an eye on. Now, no company's report is complete without a look at the risks, and Global Industrial has quite a few. They are heavily reliant on their information and telecommunication systems. If these systems go down, or if there is a data breach, it could seriously hurt their operations and reputation. They're also dealing with material weaknesses in their internal controls, specifically at their Indoff LLC subsidiary, mainly related to its general controls. This means their systems for managing important financial information need improvement, which is a red flag for any company. They also talk a lot about supply chain risks, especially with goods imported from China and other Asian countries. They are trying to find new vendors in other countries, but that comes with its own set of problems, like making sure new suppliers are reliable and maintain quality. And like many businesses, they face litigation risk. They are involved in various lawsuits. And while they believe they have strong defenses, the outcome of these legal battles could impact their financial results. Let's look at the financials a bit deeper. Their deferred tax assets show a valuation allowance of about $5 million. This usually means they are not completely sure they will be able to use up all their deferred tax benefits in the future, often due to uncertainties about future taxable income. The company's balance sheet shows about $64.3 million in goodwill and intangibles. This comes from their acquisitions like the Indoff purchase in 2023. Goodwill is basically the premium they paid over the fair value of identifiable assets. Companies have to test this every year to see if it has lost value. If it has, they have to take a hit on their earnings. They also have $91.8 million in operating lease right of use assets. This represents the value of their lease facilities and equipment. It is a significant chunk of their assets, highlighting their reliance on leasing rather than owning. Looking at their equity, total shareholders' equity is $313.2 million. This is a decent number, showing a healthy buffer for the company. However, their treasury stock is at a negative $22.1 million. This represents shares they bought back, which reduces overall equity. Now let's look at the income statement itself. We saw sales growth and better gross margins. Selling, general, and administrative expenses were up too, as we discussed, mostly due to higher salaries and stock-based compensation. The company also had a change in its effective income tax rate, going from 23.9% in 2024 to 26.2% in 2025, mainly due to higher taxable income and non-deductible executive compensation. In terms of cash flow, they generated $77.7 million from operations in 2025. This is a strong increase from $50.4 million the previous year. This positive cash flow from their main business is crucial for funding operations, paying dividends, and making investments. On the investing side, they used $7.1 million in 2025. This was mainly for acquiring an equipment service provider and for upgrades to their warehouses and computer systems. This shows they are reinvesting in their business. Financing activities used up $47.5 million in 2025. The biggest part of this was paying dividends to shareholders, totaling about $40.3 million. They also bought back some stock, adding to the cash outflow. And finally, the auditor's report. Ernst & Young LLP gave an unqualified opinion on the financial statements, which is what you want to see. But they did give an adverse opinion on the company's internal control over financial reporting. This is because of those material weaknesses at Indoff LLC, specifically about its controls. This is definitely a point of concern. So, what is the big picture here? Global Industrial Company is showing solid sales growth and improved margins, which is fantastic. Their operating income and net income per share are up, and they're generating good cash flow from their operations. This suggests they're doing a good job running their core business. However, there are clear risks. The reliance on its systems, the ongoing issues with internal controls at a key subsidiary, and the general supply chain and geopolitical uncertainties are significant challenges. Those material weaknesses in internal controls are a big red flag that management needs to address urgently, while they seem to be making progress. An adverse opinion from their auditor on this matter means there is still work to be done to ensure their financial reporting is as robust as it should be. Overall, the company is growing and profitable, but investors should be aware of the internal control weaknesses and supply chain risks that could impact future performance. It's a company with a solid business model, but also clear areas needing improvement. Alright, that is our deep dive into Global Industrial Company's latest report. What is your take on these numbers and what they signal for the company's future? Drop your thoughts in the comments. If you found this analysis valuable, smash that like button, it really helps the channel, and subscribe for more corporate breakdowns. Don't forget to check out the Discord link in the description to connect with other finance enthusiasts. Thanks for watching, see you next time.